Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He is not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. We're now at a point in the recession where economic numbers again have real meaning. And they're telling us that the economy continues to improve, but not at a rate that will get us back to normal by the end of the year. Part of the problem is that some sectors of the economy, mainly healthcare and government, have suffered financial losses that can only be made up by cutting jobs. Their contribution to economic growth will be limited for a while. But the bigger problem is that the pandemic continues to retard growth because of the surprisingly large number of people who have not been vaccinated. The new variant of the virus is more dangerous and spreading rapidly in the unvaccinated population, and will therefore affect restaurants, tourism, entertainment, and other businesses where people congregate. In addition, an increasing number of businesses and institutions are reluctant to hire people who have not been vaccinated. Let's look at some numbers. Here is the chart of the growth of all jobs in the economy compared to where we were before the pandemic. We're still about 4 million jobs short. And in the meantime, by the way, our population has grown 1%. So we're even further back than we should be. You can see the improvement since vaccination started back in March. It's been steady, but not rapid. Maybe we'll be in positive territory by the end of the year, but I doubt it. A few sectors of the economy are almost back to normal. Finance is one of them, and largely because of the recent surge in home buying. That's a topic we'll discuss in more detail next month when fresh home price data are available. Construction is another sector that's back to fairly normal operations, and again, largely because of home buying and therefore home construction. The new infrastructure bill will have a massive effect here, although not right away. Retail jobs are back to normal, although in this case, normal mainly means new jobs at Amazon and other internet retailers, but fewer jobs at stores. We should note that retail jobs were falling before the pandemic struck, so we'll soon find out if e-commerce is transformative and will create more jobs or just cannibalize the old ones. The most encouraging sign for the economy is that jobs in business services, one of the largest and most important sectors, are now back to their pre-pandemic level. It's a big deal. This sector is one of the drivers of the US economy, and one of the ways we can tell which local markets are likely to have strong real estate demand. But now we get into sectors where jobs are still a ways away from pre-pandemic levels. Manufacturing jobs are lagging, partly because demand for many products is still weak, partly because companies are figuring out how to use fewer workers. In healthcare, most jobs have returned at doctors and dentists' office, but not at hospitals and nursing homes, so the overall progress remains slow. In the large government sector, which is mainly local government, improvement or regression will depend heavily on school openings, while large numbers of children are not vaccinated. And restaurants also are still at the mercy of the pandemic. Note that the scale on this chart is 3 times as big as on the other charts. Here's the same chart, now on the same scale. You can see both the gigantic loss of jobs and the rapid improvement since vaccination started. A new surge of infections will be felt in this sector first. Here's a quick look at my personal recession indicator, computer programmers, which suggests that the recession is over, or maybe just that companies are now willing to spend money in order to use fewer employees in the future. Finally, here's a look at the overall economy, how well the overall economy is doing. Gross domestic product. These are annual rates of growth with the red bars showing the difference from GDP just before the pandemic. In the second quarter, GDP was almost 1% above that level. We're very close to a normal rate of growth of around 2 to 3% if the new surge of infections doesn't derail further progress. That's it. To finish, let me plug our investors' metro analysis, which shows how local economic conditions affect investments in real estate, down to the zip code level. And with our local job sector analysis, that can predict which markets will do best as the recession winds down. It's available for any of 200 markets, and it's easy to use as 1, 2, 3. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.